have questions, do they contact you or do they post them in a chat?
I'll post them in the chat, and then if y'all are talking or something about something, then I'll just make sure that we get them all.
Okay.
Like I'll go back, scroll back up, and make sure that if anybody asks, that I'll make sure, so that way you don't have to pay attention to the chat as much.
Okay. What does that mean?
Are you all ready? I think we got 1 more minute before it's supposed to start, so we should probably wait for a few more people to get in here.
Yeah,
But this is probably one of the. Well, I've been looking forward to this one anyway.
No pressure.
I was about to say no pressure.
No pressure.
No pressure, guys. No pressure.
Easy on us now.
Is this yours, man?
Yeah.
No, you good. No, you
You
good.
need something right on?
I was writing on this.
I don't need this.
I was already writing on a couple things. Okay. It's all good. We'll just it starts at 9:30, right?
Mm-hmm.
So it's 9:30.
And we probably, I don't think
so
we'll take the whole time either. Just depends on the Q&As.
Okay.
Okay. So welcome everybody to How to Build a Banking Relationship. We have with us from Fork Bank, we have Larry B. Forrester, who's the senior, and Michael Adams. Larry is the Senior Vice President at Fork Bank in Lexington, Kentucky. Larry is from Barnville, South Carolina, and is a Pikeville College graduate. He started his career in banking in a management trainee program, moved up to retail lending, and has spent 13 years focusing on commercial loans. He is a graduate of the Wisconsin Graduate School of Banking and serves on the following committees and boards: the Chair, Lexington Fayette County Planning Commission, Executive Board Member, Minority Business Affairs for the Commerce Lexington, Treasurer of the Lexington Community Land Trust Board, University of Kentucky College of Communications and Information Board, and the University of Pikeville Board of Trustees. We also have Michael Adams, a proud native of Pontiac, Michigan. Michael Adams Jr. is a commercial banking relationships manager with Fork Bank, and a $1.3 billion privately owned community bank headquartered in Lexington, Kentucky. He relocated to Kentucky in 2003 to play collegiate football at Kentucky State University and graduated with a Bachelor of Arts in Business Administration and a minor in management. In almost 10 years of working with businesses, investors, and working class community members, Michael has assisted hundreds of clients with a variety of resources, which include business cash flow solutions, savings, investment, and retirement management, credit, and personal banking products. He says, I give the same energy and have the same cash flow conversation with businesses, whether they have $1 in the bank or 1 million. Mike is passionate about working with underserved and underprivileged communities similar to the one in which he comes from. He serves on boards and committees of organizations that addresses the needs of those communities, such as the Community Action Council, Lexington Bluegrass Minority Business Expo, and the Carter G. Woodson Academy. Michael has also co-founded a nonprofit organization called the Kentucky Black Bourbon Guild Incorporated, which bridges economic and educational gaps between minorities and bourbon. Michael not only serves as the VP of this organization, but works with the Kentucky Distillers Association in establishing diversity, equity, and inclusion in this $8.6 billion industry. Michael is an advocate for mentorship and mental health within his community. Like you, Michael is also a small business owner of a commercial cleaning company. This experience allows him to truly understand the obstacles of small, medium-sized businesses and coach others of the resources available to overcome these hurdles. So welcome to both of you, and I am really excited about this. And we're going to be talking about the 5 tenets of creditworthiness: character, capacity, condition, capital, and collateral. And you can take it from there.
Thanks, Marlene, and welcome everyone. We are Larry and I are thrilled. Again, I'm Mike. This is Larry. We're thrilled to be here participating in this conference, and hopefully the information that we give will be able to aid you in your business and your operations and just in your growth. You do everything you want to say?
No, I think Marlene, thank you for the bio. You did make Mike sound a whole lot better than what he really is. So
Wrote more than you did, so
he did. I may have to spice mine up a little bit more now since I'm sitting next to him. But, we've actually taken advantage of this opportunity to give back. Mike and I are both implants to Kentucky. He's from the north. I'm from the deep south. So, we both are in positions to where we can help and give back. And this is going to, one of the ways we're doing that. We do it in several different ways, but this is one of the reasons why he and I are attending the conference and wanting to be a part of it, because there's so much going on, but this has been going on for years. And because we're in this career in this sector, understanding business has always been, kind of ground zero for everything you want to do with growing wealth, obtaining wealth. And you can't do that unless you understand, the finances. So hopefully we can get there today. I know that hopefully there's a lot of questions. Please ask. We're open. We don't want to bore you with a lot of the, banking jargon, because we can, but we prefer not to. We want this to be as interactive as possible. So with that being said, I'll open it back up for Mike.
Yeah, so we thought that in building as a business community and building great relationship with your bank, it's very important to understand the language that the banks speak, the language that your lenders speak, the language that the underwriters speak. And this can all be covered through the 5 tenets of credit worthiness. As small business owners with financial needs, it is important to not only stand the language of these institutions that we speak in regards to lending money, access to capital, but to apply those metrics in your business and your everyday life so that you can prepare yourself to be lendable and to get what you need from the bank. So this will not only ensure that you're only knowledgeable, but confident in your ability to position your company for capital. Okay. So there are 5 major tenets that lenders evaluate to measure the extent of a person or a company is suitable to receive financial credit. And those tenets are, as we talk about, are referenced as the 5 C's of credit worthiness. So if you guys are taking notes, you want to write this down. Those 5 C's or tenets. The first one is character. Second one is capacity. Third one, collateral. Fourth one, conditions. And the 5th one is capital. Okay. There aren't any strict guidelines for how lenders weigh these attributes. Different lenders may place more value on one over another. For instance, if you are using an online lender, they may be more willing to consider a borrower's personal credit score on a loan application to qualify that person or company, while other banks, they may care more about the cash flow, the collateral, the structuring of the deal. So, one thing that with the 5 C's is that if you are weak in one of those areas, that's not necessarily a deal breaker for you acquiring capital. It's more of understanding that particular situation and seeing if there's any other mitigants within the rest of within a broader picture that could, help that customer overcome that one particular weakness. Okay. So again, if there's a shortage in cash flow or capacity, it may be overcome with abundance of collateral through understanding the story of why it may be anomaly a year. The customer may have lost, or the business may have lost a prime customer. So there may be an explanation that allows us to overcome that particular weakness or deficit. Okay. Do you have anything you want to add to that?
No, that was good. That's right on point.
Okay, good deal. So yeah, we'll jump into Tanisha. Thank you for posting that in the chat. The 5 C's of credit worthiness. So we'll go ahead and jump into the first ones. Again, if you guys have questions, ask those questions. But we want to make this as interactive as possible, as Larry said. But the first C that we'll address is character. So what is character to a bank? Character is a lender's opinion of a borrower's general trustworthiness, credibility, and personality. Okay. Why does it matter? It matters because banks want to lend to people who are responsible and keep their commitments. Okay. So this is assessed through your work experience. How long have you been on the job? How long have you been in business? Do you know what you're doing or what you're talking about? It's assessed through credit history, through your credit score. Have you and do you and have you paid your debt obligations on time? That affects your reputation. That affects your credit score. That banks are able to get a good picture of if they're to lend you money, if you're going to pay on time via your history, via your credit score. It's also assessed through your credentials. What achievements do you have, or what's your background that proves your qualification? We look at references. Who can vouch for you? Do we know them? Are they reputable? Also, too, we look at your reputation and interactions with lenders that you may have had financing done in the past. Okay. So one thing about character is that's something that you control. You control your reputation. You control whether you pay on time or whether you do not. Okay. So the way to master that particular tenet, so to speak, would be to, first of all, be open and honest about your situation with your lender. Okay. Just be real about your situation. Too often customers come into a bank and paint pictures that further analysis does not support. So in the eyes of a lender, it looks like you're either hiding something or you're lying, and it really deters any trust that can be developed between both parties. Okay. Again, character is something that you can control and promote to a bank that cares about relationships, which I would hope that all banks care about relationships. But the reality situation is some banks have, are concentrating in certain areas. It may be just lending. They may be, just lenders, where other banks like ours, we have the capacity to handle any of your financial needs. So we want to understand the full financial picture and to provide solutions to bring that full picture over to us if possible. Okay. So different banks have different approaches. But again, if a bank cares about relationships, you want to spend the time to help build your reputation. Share good news. I'm sorry, you have something?
Sorry. I was just going to ask you if when you said that you have control whenever you pay things. So when COVID-19 came about and people couldn't pay it, if they would go to their banks and talk to them, that's part of a relationship, correct? I mean, letting them know, and then that way they're able to understand instead of just not paying it and hoping the best comes from it.
Absolutely. And that bank, we would definitely get into the COVID-19 learning environment, specifically in terms of how banks are, what type of loans or opportunities banks are looking for in this environment, because we're in the pandemic, which none of us have seen the likes of. So banks are very conservative right now and how they lend, but banks are doing everything they can to help their customers get through these times, as well as for us to get through these times and mitigate any risk that may have arisen. But yeah, if you're having difficulties, you're seeing less income, your business was forced to shut down. Again, that character piece would be get ahead of the ball, talk to your bank, see what options and solutions do they have to help you, whether it's deferment of payment, maybe utilizing some products, that moving money around, whatever the case may be. Go talk to your banker, let them know your situation. Again, your bank will appreciate that, opposed to catching it on a latter end when there's delinquencies. That sends up red flags, that affects you negatively. And again, you're not building a reputation, you're not building good relationship with your bank if they're finding out things on the latter end, opposed to you coming you coming to them, or either word of mouth. The business community, depending on the market that you're in, it could be small. So people tend to know other people's business, right? Because word travels. So, don't let your banker hear third party about what's going on with your operation. Be open and honest with your banker.
Yeah.
Do you want me to ask you the questions as they come up if they're related to what we're talking about, or do you want me to wait until afterwards? What would you prefer?
Yeah, we can ask as long as it's on topic with what we're talking about, because we still got the rest of the tenants.
Tim Rogers asked, communities, are they more thoughtful than the more big banks? It's kind of a relationship question. I mean, the character question.
Yeah, I can. There's not I guess a lot of these questions and answers is not an absolute. It's all going to determine on the relationship and that particular institution's willingness to provide help for you. And I mean, help is just financing in general. So credit unions are monitored and examined differently than banks. So they do have a little more leeway to do certain things. Some of those things are limited, some of them are not. But there's also banks. In the case of Mike and I work for Fort Bank, we're a community bank. So we're, I guess, a larger community bank, but we're not as large as, say, a Fifth Third that would be located in Cincinnati. But we can do the same deals that Fifth Third would do, but we're small enough so that we can still stay and keep our boots on the ground, local decision making. So that's where those relationships come into play. So credit unions have a place in the banking world, just as banks do as well. I would say neither one is better than the other. It is depending on your relationship with that institution. If you have a relationship with someone there, and when I mean a relationship, and we're gonna get into some of this, but it needs to be more concrete than let's say a checking account. You need to have communications between either that manager or whomever. But we'll get to that piece later time. Excuse me. But definitely, there's not a yay or nay. It's going to depend on who's going to be willing to help you, and whether it's good times or bad times. But some of the bigger banks are under different thresholds too, and they are good as well, just depending on where you are in your business cycle. A lot of startup businesses, typically a bigger bank may or may not be willing to do it. Community banks may. Businesses that are a little more on a mature stage, growth stage, that's when you're going to start getting more, I guess what I call hits from different banks. So you can create your own, I would say, banks to compete against for your business once you get to that point. And that happens all the time. But that's where that relationship come into play is sometimes relationships can help steer you in the right direction. So. Is there any more questions before we?
Alfred Swale said he has a debate going on. We, the president of the Black Chambers of Commerce, which should come first, more customer or access to capital. He says more customers.
I don't think I really understand that statement.
Which comes first, more customers or access to capital? Or more customers or access to capital? Not sure.
I would say that if you don't have customers, then you're not going to be able to get capital, because access to capital is going to be dependent upon your ability to repay. Your ability to repay is going to come from your customers. So I hope I understood that question right. I would say definitely customers, because your customers are your money to repay the debt obligations on the capital.
Yeah, and the way I interpret the question too is, it still goes back to, if it's a startup company, you're not going to have customers. So that's where it comes into play, is there's different programs you can use. So I mean, I can look at this and say, that Mike, if it's a startup, they don't necessarily have customers yet, but they need capital to get those customers. So which comes first is depending on the situation. If you're a startup, you're going to need access to capital, and that's where you have programs for startups. Now in Ohio, I'm not as familiarized with some of the programs as I am Kentucky, of course, because I'm here in Lexington. But there's still a global or federal program, which is SBA, that you can utilize for capital access, and then there's different programs through the state of Kentucky that they offer for different types of loans. Some of them will actually secure certain loans for the small businesses. I would say Kentucky and Ohio are somewhat similar. Ohio tends to have a little bit more industrial than we do right now. So that I would hope that they would have a little bit more options there, but definitely research your local chamber of commerce. Also check with your state government as well to see if there's any programs out there for that, because that is also access to capital. It's just in a different format.
Yeah, that's definitely a good point. Even with startups, to Larry's point, you won't have customers, but you're going to have projections, which is going to help you get that capital. And those projections, it's all about, again, knowing who your customers are, knowing your different revenue streams, and being able to utilize as resources, utilize research to effectively communicate. Again, you're in the startup phase, how you're going to grow your business, where's that business going to come from, et cetera. So yeah, absolutely, that's a good point. Okay. So one last thing, final thing. Oh, I'm sorry.
Sorry, I was just going to say if you wanted to continue with the character.
Yeah, one last final point I want to make about character is, I tell people all the time who ask me like, how do I develop good relationships with the bank? And I say, don't just be a customer. Be what we call a center of influence. Center of influence are partners with the bank, are partners with our financial institution, the bank, your lender. And what we do is we understand each other's needs and refer business back and forth, right? So as a customer, as you're developing, that relationship, it's great to develop your reputation through understanding your bank's pain points, understand what they're looking for. You say, hey, what kind of loans are you guys looking for right now? Like, what's your hot spot? The bank, what's your appetite? The lender will be able to communicate that. And as you go out, you're tapping into your networks. You have the potential to identify opportunities to bring back to your banker and say, hey, I talked to John, he owns X, Y, and Z, and he's in this particular industry that you guys, said you want. Is there any way I can make an introduction? That goes a long way, because when you need something from the bank, if you have that type of relationship and reputation with the bank to where they know not only you're a good customer, but you are always interested, engaged in what's going on with the bank, as well as bringing opportunities to the door. Well, that's going to add some pros to that approval list in terms of why we should do business with you, why we should lend you money, because this person refers opportunities back to us. So if there's any exceptions to make, any mitigants, we will use that.
Nice. I like that.
Did you have anything concerning character?
No, you hit it good on the point, man. That couldn't say any better.
Okay. So if there's no questions concerning character, experience, community banks, like,
yeah, it was a positive thing.
What's that?
Yeah, I read that.
Okay, well, we need to read that out loud. Larry Brown says, my experience has been that community banks like Fork Bank, keyword like Fork Bank, are much better for relationships and flexibility than big banks. I think what you need to understand, the big bank versus smaller bank debate is, what are you trying to do and who has the resources to help you do that, right? So if you're, again, a real estate investor in a town like Kentucky, and you're heavily consolidating real estate, you probably want to bank with a community bank, because most community banks, that's their niche, and dealing with local real estate deals. They understand their transactions, the market on a local basis. And so they underwrite with that knowledge in mind. Okay. Whereas a larger bank, and I came from the world of, I came from a national bank. I don't want to really put the name out there, but they were based in Pennsylvania, and their strong point wasn't real estate. So being with a larger bank in a smaller community, I couldn't take advantage of those local investment real estate opportunities, regardless of how big or small the investor was, just because that wasn't the bank's forte. They wanted healthcare, they wanted, industrial deals, things like owner occupied stuff. So again, you miss opportunities if you're banking with a large, with a national bank, and that's not their sweet spot. You're probably going to miss opportunities to access capital in order to grow your investment portfolio. So yeah, if you're in a small community, you probably want to do a bank that's either headquartered in that community or within that state, because they will better understand those local transactions, to where a larger bank based out of Texas may just take a shotgun approach. All right, be a center of influence. Okay. Know what your bank's sweet spots are. Absolutely. Marlene, that's you. All right, so we'll move on to capacity. Capacity is essentially cash flow. Okay, cash flow to a bank is about your ability to repay a loan. Okay, or whatever you borrow, your line of credit to service that particular debt. So lenders want to be assured that your business generates enough cash flow to repay the loan in full. Okay, the cash flow statement measures how well a company manages cash position, meaning how well the company generates cash to pay its debt obligation and fund its operating expenses. And this is assessed through a couple of different metrics, financial metrics and benchmarks, like debt service coverage. Debt service coverage is your ability for the entity to repay the loan. Okay, so the way we look at it is we take your annual income of the business with add backs such as amortization, depreciation, unusual expenses. We added back in there, and we service that against the annual payments on that debt. So most banks like to have that ratio at 125% or 1.25 times, meaning that you're able to cover the annual income is able to cover the annual debts at 125%. Okay. And then we also utilize the global. So we take the business income and expenses, and we merge that with your personal income and expenses, and see from a global perspective, when we add you to the business, how strong can you and the business cover your personal expenditures as well as business expenditures or debt. Okay. So you got the business debt service coverage and you got the global, and those are the two main terms you will hear. And you're going through the application process, and the bank assessing your ability to repay the loan. That's what they look at as debt service coverages. Okay. Also look at liquidity ratios as well as the cash flow statements. Anything you want to answer?
No, I think I'm gonna let you keep going. That way I don't interfere. I think you're hitting on the right topic, so I'm doing fine.
Okay. So the way to kind of, again, you got to understand your cash flow position. You got to be real about the cash flow. You can't go to a bank and tell them how strong income you're bringing in, and how the cash flow is strong, yada. And then when a bank gets the financials, it tells an opposite story. Again, that goes back to character, reputation. Be open and honest about your cash flow, because if we know where we want to meet you where you are and help you to grow where you need to be. And so some online lenders may be more open to helping you finance immediate cash flow gaps. If you're focused on local banks, pay down debt before you apply. Okay. Also, calculate your cash flow to understand your starting point before heading to the bank. So again, the art of negotiation, which a lot of times it can turn into negotiation when you go on and you're trying to get something from a bank, right? Because you want something there are strict guidelines on what they can give. So you guys want to find some type of middle ground. And, again, the best way to be confident in negotiations is to, again, know your situation, know your cash flow, know how strong or weak it may be, and be honest about that.
We have a question. How do you calculate the cash flow? Please explain.
You got it. I knew that question was going to come up, and it's easier to actually give an example in writing so folks can see it. So I'm trying to figure out, Mike, if we can do that or not. But I'll try to make it as easy as possible so everyone can understand. So what we look at, and it depends on the business, and I'll explain that. You have two sets of businesses. Some businesses are cash basis when they find on their financial statement. Some businesses are on accrual basis. So if we're looking at a cash business situation, we would take their net income, we would add back any depreciation, which is a non-cash expense, plus add back the interest expense, if there's any debts currently with that business. And then after that, we would come up with what we consider and call net operating cash flow, which would be net income available for debt service, or income available for debt service. We would take that income. Next, we would look at the loan payments that you want to borrow from the bank. So let's just say your payment is $2,000 a month, and I'm just throwing it out there, $1,000. Let's say $1,000. So your annual payment debt service would be $12,000. 1,000 times 12, so you got 12,000 over that year. We would take that, divide that into that net cash that available for debt service to come up with the ratio. And what Mike said a few minutes ago, banks are different, but most of them are somewhere between at 1.20, 1.25. I've heard in certain states it may be a little lower, maybe a little higher, but you can ask those questions, but you would be pretty good there. And just to give you a little bit more background, the 1.25 means you, out of every dollar of debt you have, you got $1.25 of income. So that's basically how we look at it. If it's less than that, that's when that's when the concerns come into play. And you never want to be below a 1, because that means you don't have enough income coming in to pay your debts. So if that's the case, there's other things that we look for, in the sense of look at your liquidity position. And what I mean by that is how much cash you have on hand, or what do you have access to cash? Can you turn it into cash within a week's time or 3 to 4 days? Because if you have a less than 1% debt service coverage ratio, there's other things going on that needs to be addressed, and you probably don't need to borrow right now. You need to focus on, more than likely, you got some expenses that are out of line, and there's other trends that we look at as well. So we can go really deep into that. I don't know how much we want to go into that piece of it, but without having a financial statement, that will be okay. But we can't share that. We would have had to make one up for you. But I do know from that standpoint, that's how we would calculate it. Now, from an accrual standpoint, and I give an accrual example, or a company example. If you're a marketing company or you're selling products or services to anyone that doesn't pay you day one, you're sending them an invoice and they're paying you a net 30, net 60, net 90. Well, we take a look at that cash flow a lot differently as well, because even though you sold the product, it's already went out of your office, out of your place of business, you have not been paid yet for that. But the expenses to make that product or perform that service has already been done. So your expenses are going to be moving in a higher pace than your revenue stream. So then you would end up having accounts receivables. And that's typically where, we would do what's called an accounts receivable line of credit for those type clients. You have that in the construction industry. They typically don't get paid, 30, 90 days or whatever. And they usually will have a construction line of credit for that particular project so that they can pay their employees. Because as business owners that have experienced this, your employees doesn't care when you get paid. They want to get paid when you say you're going to pay them. Just being honest. They can care less about Joe Smo not paying you. You got to pay them. And to keep employees, you got to be able to do that. And that's where that line of credit will more than likely come into play. So you can keep that cash flow flowing in until you get time to receive those receivables. But on the calculation of that is we have to look at, the receivables you have outstanding, because that actually comes off your cash flow because you haven't received that yet. So it's different ways to calculate that. And like I said, it's a little bit more in depth when you get to the accrual based calculation than you would a cash base. And I know Mike and I'll be happy to go over that at some point. We'd probably be best looking at your financials in a sense to kind of determine that instead of, we can bore you with the underwriting pieces if you like. But that's the reason why as community bankers, I've always been in community banking. So I had to learn this early on. I worked in the underwriting departments and stuff. So that helped me understand that as well. And then getting out there and speaking with clients, learning the business. And that's the fun part, understanding how clients, make money, the struggles, how can you help them? And it's more listening than anything. We can bring you every option available, but if it doesn't work for your business, it doesn't matter. So what we try to do is make sure that we listen closely, and we may not have a solution day one, but over time we will. But I'll segue into my piece. I think Mike left off collateral. Oh, you got some questions? Okay, well, I won't do that then. I'll wait. That's even better.
So Donita Smith asked, what if you are a startup and have the projections only and your personal credit is not the 620 they are looking for? Is there another method or way to get funding while you're working on your credit?
You want to help us?
Start up with.
I'll segue on my personal opinion is that you don't want to start a business until you get your personal side situated. Because personally,
what would you recommend?
I would recommend pulling your credit report or asking the bank to allow you to get that credit report to see why your credit score is at or not at the level it needs to be. And then look at ways to improve your credit. Now there's different programs out there. I'm not going to recommend any program to do it. I'm from the country, so I figured we do it. You get up there and you just got to fix it. And a lot of times it is if you've been late on certain debts, all those debts, can you bring them back current? Or if you're bringing them back current, can you go ahead and pay them off? That's an opportunity as well. There may be an opportunity for, you may have some credit card debt, some type of debt consolidation as well to lower your payments, but to get everything into one loan, and it may be more feasible for you, especially during this time. You're kind of in a low rate environment. That's an option. I'm never a component of a credit card, but I will say there's ways to utilize that 0% type financing they offer for as long as period as you can, because now you're not paying any interest. So every payment is going directly toward the principal. That's going to allow you to also put yourself in a better situation. There's different, for that question, without seeing your whole picture, just kind of giving you some, experience stuff, you can look at that opportunity. But you do want to get your personal credit together, because that also not only affects your business or potential business, it affects you wanting to buy a car. It affects you if you want to buy a house. Heck, nowadays it affects you if you just want to get cable or satellite. They pull your credit. Renting.
Insurance.
Insurance too. So if you work on yourself first, everything else, that's part of the foundation. I look at personally, you got to cover yourself, and that you're the foundation, and then you build off that. So there's not a quick fix. Don't get me wrong. Some folks come into money, but you got to sit down, write down all your bills that you have debt, not your electric and things of that nature. Monthly debt obligations. Write them down. Write down the interest rates to each of those. Figure out which one is the highest to the lowest, Then next step you would look at is say which balance is larger and smaller. The smaller balances, you may be able to pay those off sooner. So tackle those so you can get some easy wins to make some feel goods. And then give yourself time to get that done. Because right now you may not be, qualified or ready yet. And there's no need to go into the bank if you're not qualified and then you get your hopes down. Because if your dream is to have that business, sometimes taking the time to get yourself in position will allow you to also think of new ideas. Something else can come out, but it may help you in the future. But I would always say work on yourself before you try to start a business. That's my opinion.
That's perfectly said. Again, that goes back into, I mean, he said it perfect. I just want to piggyback on one thing. When you come to a bank, again, this is the language that the bank speaks when we're talking about the 5 C's. They're going to evaluate you on these 5 metrics, right? So when you talk about a startup, which is very, very risky, and low credit score, they don't go together. So it's okay if you're not ready, okay? We have to, like Larry said, you have to be real about your situation, and you have to put your attention on what you can control. Even if you were able to get credit by some lender out there, it's going to be very, very expensive, because those interest rates, they're going to price for the risks associated with that startup. They're going to price with you having a subpar credit score. So sometimes the answer is, let me figure out how to make my credit better before I go to a bank. You may want to consult with someone who specializes in building credit. And I'm not saying go talk to one of these guys that's going to wipe your credit clean, because I don't agree with none of that. You just got to figure out, what professional can help you with understanding why your credit is the way it is. It can help you build from there, okay, in a reasonable way. So again, you're already going against the grain if you go talk to a lender and you have a startup as well as a low credit score. If it was a startup and your credit was great, then the bank's got something to work with, because say, okay, it's a startup. We'll look at the character. We'll look at, what qualifications she had or he has to start this particular business. But we can tell from his credit score that he's going to be serious about paying us back. So that's a plus. So that's how you mitigate it. Startup, credit score good. So we can put potentially, as long as it's a great opportunity, has good projections, and we can visibly see the repayment source, the growth of that entity. That may push it over to across the finish line. But I can tell you right now, low credit score, startup, probably not going to happen. And that's just the honest God truth.
Yeah, especially now.
COVID, it's not happening at all.
Oh, yeah. So Deborah Davis asked, what financial ratios do banks look for, and which financial statements should businesses be looking at to calculate the financial ratios? And these were posted when we were talking about the capital, the cash flow statement.
Yes.
All of them. Yeah.
That's true. Well, we want to tell them which ones.
I say the main ones, like, we talked about the debt service coverage ratio. We talked about the quick ratio. We mentioned that. We look at loan to value. Okay. We also look at leverage.
And then if you're a business that have accounts receivables, we look at accounts receivables, aging report, and we calculate from year to year your accounts receivable days, or collection. So if you're, for an example, last 3 years would be 17, 18, 19. And from 17, your collectible days of accounts receivable went from 30 to 120. Well, that's a problem. And the reason that's a problem is because now you have money sitting on the sideline that you have not collected yet, that you could be using to fund your business. So the question is going to be asked, well, why or what's going on? Or the opposite. They could have went from 120 to 30. Now, hey, that's a good thing. Well, how did you make that change? What did you do? So the aging report is good. As Mike mentioned, the quick ratio is more of a ratio for us to look at, or a current ratio to determine how fast you can turn your assets, your current assets, into cash. And that's always important, but that doesn't go for every business.
Mhm.
And that's the thing. There's not a one, I guess, it's not a cookie cutter model. I know that a lot of folks says that, but it's actually not. And that's one of the reasons why I like community banking, because we're not a cookie cutter type model. You know, Mike is different from me. I'm different from Mike. I mean, Marlene, she's different from us. But that doesn't mean that all three of us can't get the same loan, but structured differently depending on our needs. So having that flexibility to do that in the community bank, and I'm just going to speak community banks. That's what I love. I think that's the way it should be. Those businesses can prosper and also have options. And to be able to have a conversation and sit down with your banker, I think goes a long way. A long way. Even with the credit score question, if you went into the bank, in my opinion, if the bank just tell you that you denied, and that's all they have to say, but you probably going to want a little bit more reasons as to why. So sometimes it's not about saying no, it's how you tell the individual how they can get credit worthy, so that you don't, destroy a dream. And sometimes it may not work, but if you give them a game plan or a start of a game plan, that's just kind of the way I like to do it anyway. But it seems that would be better fit than just to say no. Not everybody, you can't say that way. Some folks you got to say no, but majority though, that you can give them a roadmap as to what's going on. There was a question too on the other financial statement, your income statement, your balance sheet. Those are key. Of course, we look at that as well as your tax returns. So typically we would get 3-year tax returns if you've been in business for 3 years, most prior to get the income statement up to the point in time that you come into the bank, or most recent. Typically banks like to look at quarters because we do our financials in quarters. So you always probably hear, what do you have as of March 31st or end of June, end of September or whatever. So it's when you're looking at those, that's what we look at. And then we may ask for the year prior to just compare to see if you're on that same trend. Because trends, as Mike can tell you, we both get underwritten based on trends, and we're like, well, the trends are going up, but we got to have reasons as to why. Is it an anomaly? Did something happen? So those are questions that we would ask, a little bit more in-depth questions. So that's a good deal. There was a question here that says, what's a great credit score? Well, you can only get an 850. So I'll probably say the highest score I've ever seen. I actually seen I've seen an 850 once, but that's few and far between. I mean, I still don't know how they got 850, but they were at 850. But that's the highest you can obtain is 850. So, but a great credit score, I don't know.
750. I think that.
Yeah,
pretty much get tier 1 pricing out of 750.
Yeah, but because, as I mentioned, community banks, it's about relationships. Sometimes your credit score may not be quite there, but we have a relationship with you.
Mm-hmm.
I mean, that has happened. That's what I said. We're that cookie cutter type model. Now, for individuals that doesn't have that community banking relationship, and even if you don't, I mean, that doesn't mean you go out and just not pay your debts and have a low credit score. You want to be somewhere in that 700 range and above, if possible. I mean, I think subprime now is 640, 660. So I wouldn't recommend that. I would recommend just try to get the best credit score you can. If you're in the 700 or above, then you're where you need to be. Like you said, 720, 730 are good numbers. What's that? So Marlene. Oh,
So
okay.
Deborah
Yeah, I missed
asked,
something.
how
I think she's
difficult
putting
is it for a small business to get a line of credit, and how much credit should a business request? Small businesses tend to go for low-hanging fruit, and then they can't get by.
Well, you can take them.
Yeah, so how difficult is it for a small business to get a line of credit? Again, it just depends on the business. Okay. Is there a need for a line of credit? We got to understand line of credits are used for working capital. Line credits are used to bridge gaps between payables and receivables. So when we're doing our analysis and we see that need there, then typically we'll underwrite a line based upon that need, which is typically a percentage of accounts receivables aging report within 90 days. Because after 90 days, unless again, there's an explanation to why you have an account that's past 90 days. We consider it non-collectible. So if it's taking you 90 days to collect money from a customer, then we essentially assume that you're not getting paid. So we look at a percentage of the accounts receivables, agent report, a percentage of that. We also look at, are you generating enough cash to cover that the payments on that line of credit? Okay, so I don't think it's too difficult. I think it just depends on the business and if there is truly a need for a line. It just has to make sense. How much credit should a business request? Again, just a percentage, just what you need, a percentage of your working capital. I know that some banks, large banks, they'll do, and I came from a larger bank that did this, they'll do, as long as the cash flow is there, they'll do 10% of your gross receipts up to 100,000 unsecured. And then over 100,000, you got to have collateral, but they'll still stick to the 10% rule. Okay. We don't work like that. But every bank has their different approaches, how they treat lines of credits and the different sizes. So you would have to really talk to your bank and see, ask them, how do they assess lines of credits? Okay.
Said accounts receivable, age of report, and relationship are all parts of what a line of credit is based on.
Yeah, accounts receivable aging and also accounts payables. Aging
and accounts payable.
Yes. Okay. In that question, let's see. Yeah, just asking for the amount. Typically, I mean, if it's an existing business, a lot of that is going to be tied to previous history, and some of it's going to be tied to new business, to where there's clients that are in significant growth phase right now. I mean, even though COVID is going on, there's people that are prospering. Mm-hmm. So they may need an increase in their line of credit. So that will be determined based on the amount of, I guess, new business that they have. So that individual client has to provide what I would ask for a spreadsheet of what new businesses that you have coming online. Have you signed any contracts? And then you will know how that will work, because you would end up dictating in your contract how you're going to get paid. So if you know you're not getting paid in net 30 or net 60 or whatever, then you can base your current cash flow on the difference of that compared to what you got coming in. And that difference is going to allow you to determine the type of line you're going to need. And it may be a short-term line of credit, but it's going to allow you to make sure that your people are being paid so that you can perform the work, so you can continue to be fulfilling that work agreement or purchase agreement or service agreement whatsoever. So that's kind of what, there's not a really, I never see it look at a percentage. It's more like, some businesses, I have a business that they get 20-30% of their sales as a line, but it's the type of business that it is. They need that. Yeah. Some of them are not. So it just,
especially seasonal businesses, there may be 3 or 4 months in which you're collecting the bulk of your cash. And so, the rest of the year, you may have to utilize a line in order to get to those busy peaks, again, continue to bridge that gap. Also, too, with the line of credit, it's important to understand a a line is what you want to use for short-term purchases, for, short-term working capital. Okay. So the way we look at a line is, one of the questions we ask is, like, say, if you got to buy inventory, or if you have to purchase some type of equipment, we ask questions, how long is it going to take you to pay that line off? Because it may be a term loan that you need if it's going to take more than a year, 2 years, 3, 5 years, than a line of credit, because a line of credit is supposed to work like a credit card. You use it, pay it down, use it, pay it down. It's supposed to fluctuate. What happens is when you get a line and you put these long-term purchases on that line, it ties that line up. And when a bank is doing this evaluation, that line isn't functioning the way that it's supposed to function. So it puts up red flags for us that, hey, we need to do something different, or we need to call this line because this customer has used these funds up and hasn't, paid it down, which means that there's some type of financial distress potential that may be going on with the business. So it's very important to understand short-term versus expenses and how you're going to use that line, and what's your line to, what's your plan to pay that line down in a month, 2 months, 6 months, so that you can communicate that to your banker as well.
Yeah, that's a good point. That's I think in my years of experience, just dealing with small businesses anyway, one of the biggest, I guess, myths out there is, well, I can borrow a line of credit and just pay the minimum payment. If anything you hear from today from me and Mike is never pay just the minimum payment. Like Mike says, it's like a credit card. But
right.
lines of credit are reviewed annually, so it's not like a credit card either. So the bank will have the ability to, they are only committing to you as a business that length of time. It might be 1 year or 2 years, but if you don't fulfill the contractual agreement based on your promissory note you sign and loan agreement, the bank can ask you to leave or pay it off. So instead of putting yourself in that position, when that receivable comes in, that should go and pay the line down immediately, because then that line is going to be utilized for any other future business. What I've seen from an example of what typically happens, and this lines of credit are taken out, the lines are used, they're not, money is being made, but it's never being paid back. So then when that business gets to a point of, hey, I want to get a new project or start a new project, but I don't have any more line of credit capacity, where you actually have, but you've utilized that now and kept putting it in the checking account. So mentally, you have to change up the thought process, because everybody will want, hey, I've got a check, I'm putting in the checking account, I want to see the cash. But if you got a line of credit and you got a balance on that line of credit, you have to be a steward of your financials and make sure that the business is financially healthy. And the only way that business is financially healthy is if you have access to capital that you took a loan out for, because it's supposed to revolve to allow you to grow and to allow you to sustain your current operating expenses. There was a
Okay, we have a question. Oh, sorry. Go ahead.
No.
Okay. Are professional service-based businesses evaluated differently than businesses that sell products? If so, in what ways?
Yeah. That's the answer to that. Yes. And I'm trying to give you a professional-based business. Say it's a marketing firm that deals with other businesses to help them increase their market share in some form or fashion. And a business that's selling widgets, and typically that business that's selling widgets has inventory, then has to turn that inventory into a product to be sold. With a marketing company, more than likely, will have a contract or some type of service agreement, and they may have ARs, unbilled work, as well. So the way we look at them financially differently, cash flow wise, it's about the same. But the AR aging report, actually, in this case, for an example, from the professional service business, we would have accounts receivable aging report plus the accounts payable for the business that sell products, we would more than likely have a lien on the equipment and a lien on the inventory. So we would take a percentage of both, because you can't have ARs unless you turn the inventory into a product to be sold. Yeah, that we could go real deep on that one. But I think that may be easy enough for folks to understand. There is a slight difference there. There's a slight difference on how do we evaluate them. Now, the evaluation is still, if we were needed to be a 120 or 125 debt service coverage, that's still the same. That doesn't matter. But the professional service business are typically, you don't also have a lot of collateral outside of the accounts receivables. When I mean collateral, the tangible collateral that you can touch, some folks
Hard
have
assets.
hard assets, and that was also part of the C's, one of the 5 C's. So a bank that's have the appetite for those type deals would be the ones you would want to go to. There's some banks that typically will not lend with that because they feel the risk is a lot greater, because if there's an issue, they don't necessarily have tangible hard assets. And theoretically they do, it just depends on the type of receivables. But that, again, Marlene, Mike and I can give you a lot of examples, but I just want to keep it basic right now until we get there. So is there any, I think there's another question too. Let me see, what are some of
about 30 minutes, just letting you know.
Oh, we have 30 minutes? Well, I'll go as long as you let us. As long as they have questions, we got to keep going.
So that,
Okay, go ahead.
what are some of the mechanisms, programs that banks use to manage racial bias and lending by evening the lending landscape and or actively engaging underserved and historically discriminated communities? Sound like a CRA.
Banks use to manage the racial. Well, kind of, sort of. All banks have, it is a CRA deal. And what we mean by CRA is Community Reinvestment Act. Every bank is required to have, you can ask, anybody can go to their bank and say, I want to see your CRA report from the federal government that they the examination. You can see that. It's public knowledge. With that being said, that doesn't mean that they're doing everything they could, but that means they could be doing what's needed too. So a lot of times it is up to that particular institution. And there's different ways to invest in the underserved communities. But we do have, I'm not going to say buckets, but we do have, I don't say how to say, we have to serve our underserved areas if we are in those communities. If we're not in those communities, then we do not. But in a sense, like we're here in Lexington, Kentucky, so there's certain zip codes that meets, and there's certain businesses that actually does things in the community. And I just give an example, the Lexington, the Urban League of Lexington. I'm on their board. They focus heavily in Lexington on providing housing for the underserved areas. Okay. With that being said, the Urban League doesn't, they have to borrow money for that. So as a client, the Urban League will go to a financial institution and borrow money for that. So that would be an example. There's other nonprofits as well that does those things that I'm involved with. But from programs, there's not necessarily, we don't have like a program. We try to do the right thing for the right reasons. As you can tell, me and Mike can't pass. So we make sure that we're in the community that we serve. And there's different things. Mike is also with the Carter G. Woodson Academy. That's, young minority males that have an actual school here in town. So that's part of the CRA too. Sometimes it's not as much monetary, it's our time. We are actually required to provide time, but we don't have to make a requirement. We do that because it's the right thing to do, and we like doing it. So I can't speak for other markets or anything like that. I'm only going to speak for what Mike and I do, because it'd be unfair for that. And what was the other one, Mike? He said, then landscape actively. I think I did that. I hope I answered your question.
Yeah, so we have to, and we're audited on this. We have to ensure that we are investing time, resources, capital into underserved communities, which, not necessarily from a ratio where race plays a factor in it, but it's really from a poverty standpoint.
Income.
So low to moderate income communities, we have to invest dollars to ensure that we're not just going to affluent communities and middle class communities and pumping all the resources there, where the low, communities that are in poverty are still continue to be in poverty. And so, we lend money to those areas. We give special rates in those particular areas, special structuring, lower cash injections. And so, we really are heavily invested in building up the low to moderate income communities, which we know affects, minorities, living in those particular communities. And to Larry's point, we also ensure, when you're talking about leveling the playing field, we make sure that we get the bank involved and keep the bank involved and engaged in the communities in which we come from. So that's a personal initiative that we have, and the way we give back is to make sure that our communities see some of these bank resources, some of these bank dollars. Okay, our communities see us on marketing, within marketing, on billboards or commercials or whatever the case may be, because that representation is very important. And the way we see it is we're paving the way for the next banker, the next banker to come in and have a solid foundation, and and a blueprint in which to give back to the community.
The next president of a bank, banks, whether they're male or female. We know how hard it was for us to get here. We know how hard it's going to be. But so whatever we do is a direct reflection on the future.
That's right.
We understand that for sure.
And that's one talking point I have too. Sorry to cut you off. That's one talking point. Any bank that I join, before I decide to join that particular team, I ask the question, or I make the statement that if you guys aren't interested in investing in the communities that I come from, then I'm probably not your guy.
Yeah.
And it's real simple. So you get that commitment on the front end, and then you have your acts that make sense, and as long as it makes sense for the bank, they'll support. So we've been fortunate with Fork Bank that they don't tell us no too often. They know better. But they're good at understanding. I mean, they're great with trusting us to make sure that their dollars are well spent and going to great causes. And so we don't get much flack on anything that we want to embed the bank in.
And you just use this as an example. This conference is out of Cincinnati. We're in Lexington.
That's right.
So, that even though we can get to Cincinnati, so we'd love to come up there. We got market in Cincinnati, and we do business in Cincinnati. We can do business from here in Cincinnati. So, but that was one of the things that we thought, it's kind of different for me and Mike to be together in banking. But it's good that we've been known each other for years. So it's just kind of a thing where, we talk, we converse on many occasions. So it's me over here and he's over there. Because it's not just our thing. It's hopefully we can continue to build off this. But there was a question.
We really appreciate you being here. That's for sure. You give us a lot of great information. We have another question. What if you are on disability or SSDI and a startup business? How does that affect the lending?
Well, I engaged with several folks that's been in that situation. Well, you would have an award letter, of course, for your disability and your Social Security every year. So it would be calculated as income as any other income. Now, I don't know what type of business you're going to start up, so that's totally different. But from an income standpoint, it looks like the way I would look at it, you have two sources of income currently, which would be disability plus your Social Security income. So with that, we're going to look at, as Mike mentioned earlier, okay, what type of business you're going to start up. It has to make sense for the bank before the bank will get behind you. So it has to, and it needs to show that it's feasible. And if you can sell that to the bank, then, it doesn't really affect your lending at all. We just have to look at it because if you use, SBA had a program that was just for veterans. And I've done some deals with veterans that were, at the time, this was several years ago, it was called the Patriot Express program. And some of those veterans were disabled per federal government guidelines, military guidelines. And, we still were able to provide financing for them. It's just depending on the type of business it was. This individual was buying a new business or an existing business, but it was a new business to him. So let's also probably need to clarify that too. Even though it's an existing business, if you never had experience in it, it's going to be looked at as a new business because you don't have the experience. Now, if you had experience in that, but never owned it, that's a little different. That's why we're saying as a community bank, we look at everything. Sometimes we probably look at too much, but we really like to know what's going on. We like to, in a sense, we want to paint the Picasso because if Mike or I are going to take your loan in and want to get it approved, we don't want to go in and get it approved when we got half information and we not prepared. That's something that we can't do. And then we may not know everything, but we need to get as much information as possible about the business. So affecting your lending piece of it, it should not affect your lending piece just because you're on disability or Social Security. That should not have any basically stance on not getting financing. It just depends. I mean, if you're disabled, that doesn't mean you can do a lot. So I don't want to get too much into that, but because that's also sensitive. But you can do a lot being disabled, and that doesn't stop you from owning a business.
Yeah, I mean, that's actually you have consistent income coming in from that disability, right?
Yeah, every year you get an award letter,
yeah.
Usually at the end of the year, beginning of the year, the end of the year, that tells you what your disability monthly income is going to be for, let's say, 2020. Mm-hmm. And then your Social Security is about the same. So you get it. So that you got income, even though if the business doesn't make it, and going back to what Mike had said earlier, we would know, or the bank would know, you got income coming in. Mm-hmm. To hopefully, if there's a hiccup or issue, to support the payment. Mm-hmm. And that goes into that cash flow statement that we talked about. There's another question. Mike said, what?
She says she's applying for disability, has a cosmetology and barbering school, and over 25 years of experience. And we have 18 minutes left, and we still have to touch on the condition, I think. And
we got to touch on, I hit collateral a little bit, conditions and capital, but I'm not going to fly through it. But before we go there, though, Ms. Smith did have that question. What if you're applying for disability? If you're applying for disability, that's, you want to make sure and see where you are if you're going to be awarded that disability. And typically, again, I guess they send you the letter by mail still or email, but you want to make sure that award letter comes to you so you'll know that you have it. Just applying for it for the bank doesn't mean you're going to get it. We need to know how much you're going to be receiving, because they may cut it and say you're going to receive 80% instead of 100%. But you would want to know that as well. So we would need that award letter to solidify the disability. She was emailed, I'm meaning if you're applying for it, but she asked another question. Oh, okay, she said, gotcha. Okay. All right. Yeah, I did. So collateral, conditions, and capital, we can touch back on that kind of briefly here. Mike asked me to do that piece, so I'll do my best. On the collateral piece, a lot of businesses, and some businesses, not a lot, I say this, some businesses may not understand what's considered collateral or not. So collateral could be, of course, you have tangible and intangible, which tangible is something hard you can touch, intangible is something you cannot. So we actually touched on this, so it's a good segue into it. Tangible collateral for the bank, number one, best piece of collateral the bank can have for a loan is cash. It's number one. Now everybody don't have that, even though some of the rich people, they're not gonna put the cash up. But just FYI, it's the number one. Second is an investment account, not your retirement. You can't collateralize your retirement account. It's illegal. If you have an investment account separate, maybe through Charles Schwab, and I don't want to say all the name, I miss some, or AG Edwards, or your own personal. That's the second. And then from there, you have real estate. You may have equipment type stuff, whether if it's a big machinery that you use to do your fix your products or manufacture your products. You have accounts receivable, have inventory, vehicles. Some companies have fleet vehicles, tractor trucks, or actual cars, automobiles. So those can be used as collateral as well. I said real estate. I'm trying to think, and that's now when you get into the jewelry and the collectible of art, that's not something I would not put up, especially for the community banks. I mean, that's not something we can, touch. We can't sell that. So it really doesn't have much value to us. And I know Marlene had asked me before we started to basically just don't go through these 5 C's and kind of, be a professor. So I was like, great. So she did ask the question though, is how can you get collateral and what can you do? And which I thought that was a good question. No one had ever asked that of me. So if you don't own your home, and for an example, you could or you could not. Let's say you don't own your home and you're coming in and you want to borrow money, but you don't have that collateral to use. That's when you got to have some type of collateral support program behind you, which is utilizing the Small Business Administration Guarantee Programs, which is SBA. They have, guarantees up to 75%. I think it's higher now. I did one, it was at 100 not too long ago. Mm-hmm. And what that means is it doesn't mean that just because you got the guarantee that loan, we can do it. It means that in case of we have a collateral shortfall, which you don't have the collateral fully, we can utilize that only if we feel that the loan is feasible enough to underwrite. It doesn't make a bad loan good. The SBA is not used for that, but SBA is used as a credit enhancement for small businesses or startups, or actually in existing businesses too, because I've done that on a lot of existing businesses as well. Just depending on the project. So having that credit enhancement is key for you if that's a need. If you don't have, that tangible asset readily available. Now, if you don't want to go that route, of course, if there's someone could, let's say, Merlene was going to be really nice to me and she allowed me to use her house as a collateral. She can do that. Now, that's between you and her, but there's documents you can sign. She's not smiling, so I don't think she's going to give me her house collateral on my loan. But you can do that, so if you had a family member or something like that, just mother, father, grandmother, grandfather, aunt, uncle, they can allow you to use collateral that they have.
Have to be a relative?
Huh? No, it doesn't. No, it doesn't have to be a relative. It can be a friend or whatever. But if the collateral meets the requirements and they sign off on the appropriate legal documentation, assigning that collateral over, you can do it. Because at the end of the day, as Mike mentioned, the bankers want to make sure that they're in position to get repaid if something happens. So I'll slide that over on the collateral piece. So the next one is conditions. And conditions can mean your interest rate in your loan, the amount of the loan, the term of the loan, Depending on the lender, every condition could be different. Business loans are not like a personal mortgage where pretty much everything is it's cookie cutter. You boom, 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 boom. It's business loans, moving parts all the time. So you could have certain conditions on your loans that you have to pay attention to, like in your loan agreement. As we stated, those ratios, a lot of those ratios that we spoke of are annual covenant ratios that may or may not be beneficial to your business. Because sometimes you can be put in a situation from a business standpoint from a bank that will be detrimental to you. Because if you're a startup business, having ratios may not benefit your business at that time, especially in the first year or two, because you're ramping up. You're going to have more expenses, more than likely. You're going to have things going to happen. So you definitely pay attention to those. Having a debt service coverage ratio first year when you just start up, you never want to put yourself in a position to fail, but that would be hard to do because you're going to always have more capital outlay first and expenses going forward. It's typical. That's how that works. So definitely pay attention to that. Then I guess, Mike, you had some other things on conditions. I guess a lot I can go into it. One of the things that Mike and I talk about a lot is the economy that we're in. And we don't really know what economy we're in right now. If anybody says they do, I wouldn't believe them because we're not sure where we're going. We've got election, COVID, and also this significant racial divide. So things are a little tense right now. So, just trying to understand the economy to the best of your ability is key. For us, trying to understand your business to the best of our ability is key. So we try to look at it as a partnership when we're doing that. So from a condition standpoint, that's where I'm going back to. We got to really make sure that we're not setting you up to fail. We're setting you up to succeed. So that comes into play on listening to you as a business owner, understanding your business. And that's why those questions are being asked. The last one is capital, which is, it's cash. Everybody knows cash is king. It's 2020 and cash is still king. So from the capital standpoint, what we look at is we like to see how much money you have invested into your business. And it doesn't have to be a startup. I know we talked about startups a lot this morning, but it could be an existing business. We want to see if you are retaining that income and reinvesting that back into the business. So we look at that on your balance sheet. If every dollar that you're making out of business, you're taking and spending, that may or may not be good. It depends on the business. I'm not going to say, hey, that's bad or hey, that's great, but just be mindful that, a lot of banks do like to see that money is being reinvested back into the business as well. And you're not just draining the business to, have whatever lifestyle you have. But, and if you do have that issue, we just got to there's always underlying assumptions to everything. So just give us a reason on why you're doing what you're doing and to explain it that way. But majority of the capital that we look for is, as an example, if you're buying a piece of real estate, if you are buying a piece of equipment, what type of down payment do you have? 10%, 20%. Of course, 20% is always the norm. You're going to hear that. But here, I've heard some folks would like to have 25. And I'll tell you the reasons why you want more down payment as possible. Less is not best in banking, because if you want to borrow less money, more than likely you'll be approved. If you're going to borrow more money, we're going to look at more stuff. We're going to dovetail into it and look at it. So our risk factors is based on how much you borrow based on the collateral value. So if you're borrowing at 80%, so that means you put down 20% compared to 30% and you're borrowing 70. We know at 70%, we're probably much in a good position. Now, 80% will get you there. Don't get me wrong. But having an extra 10, it makes you feel good. Now, that's a lot of wish list stuff that we would like to have. I know Mike and I would probably like to have that all the time. But, that doesn't come up all the time. So if you don't have that, that doesn't mean you don't qualify or anything like that. If anybody is on here from the state of Kentucky, I'm not sure if they still are doing it, but they did have a program, which was a collateral support program or down payment assistant, where they would actually provide like almost 10, 20% as the down payment. And it was cash to secure the loan with. So for an example, if it was $100,000 loan, they would give up the $20,000 in cash that we would keep as collateral. So now the bank risk is 80. So now we're hoping that the 80 is secured by a piece of collateral that's worth at least 80,000 or more. Like I mentioned, I'm not sure what Ohio is doing, but those are different opportunities.
Similar.
Good. So, and this is not part of the 5 C's, but the biggest thing I've said, and Mike has said it probably 10 to 15 times, is relationships. I don't really care what the 5 C's says. If you don't have good relationships, it doesn't matter if you got any of these, because someone will take a risk or take the opportunity to help you if you build the relationship. And building that relationship is, you got to cultivate it. You can't come in and just speak to the teller and say, hey, and then leave. You got to create conversations. Talk to whomever, whether it's the teller, the branch manager, the assistant manager, the commercial lender, the market president, the CEO, get in front of them and, ask questions. Tell them about your business. We want to hear about your business. And I said this in one Zoom meeting, we want to take you to lunch or breakfast or dinner. Ask.
Let's go.
Yeah, it's just, we want to do that, and we have to do that and understanding. So you'll find it real easy to get a free meal, just to get a free meal and talk about your business with your banker. Don't think your business is too small for someone to hear about, because at some point every business had to start from somewhere at some point. So you can be that business you may be here already, you may be here that can get here. But keep that conversation going, because we as bankers do hear a lot, and we can refer you to different opportunities. And that's kind of what we try to do. And I'll open it up, Mike, if you want to add some more to that.
No, I mean, perfectly stated. I would say, again, going back to, don't just be a customer, be a center of influence, be a partner. Help us help you get to where you want to be. My clients have my cell phone number. Same thing with Larry. Like, we're at football practice, taking calls and answering questions, things of that nature. So, your banker is supposed to be as dedicated to your success as you are. So in order to have that, like Larry said, you can have, when you meet with a banker concerning loans or products, they're either going to work hard to decline you, or they're going to work hard to approve you. If that relationship was there, they're going to have some incentive to work hard to get you approved. So again, relationships are important. Figure out who you're as a business. You should not just be only dealing with a branch manager. You should know who your business lender is. You should have a relationship with a business lender. And if that bank doesn't have a business lender that's willing to meet, to talk, to advise you, then you need to find another bank. It's just as simple as that. You hire and you fire your bankers.
We have a couple more questions. Deborah asks, should business owners set up appointments with branch personnel? And Eric Kearney asks, do you advocate for small business owners to the loan committee?
Well, I think Larry answered the question. I think appointments, absolutely. If you're offered appointment by your banker, take it. And do you advocate for small business owners to the loan committee? I'm not sure which loan committee we're talking about.
I'm taking that as if we got a deal. Are we actually working hard to get that deal across the finish line, or are we just taking what the client says and not providing any additional information? I think when you said that just now too. But
Yeah.
That's the way I understood that.
Yeah.
In
Well,
terms of that
we serve as commercial lenders. We serve as the middleman between the customer and the bank. Okay. We understand the customer story. You know, we collect financials. We do some underwriting to understand what we're working with and to properly advise a customer is it, you know, if they're credit worthy, if we're ready for application or what modifications we need to do. And that if that customer approves to go into application process, then we advocate for that customer because again, we have reputations as lenders as well. Okay. We don't want to send bad deals up. We want to send good, workable, sensible deals because as these underwriters who are dealing with numerous of, opportunities in terms of underwriting, we want to make sure that they're receiving something good that they can work with and that we can negotiate with them on to get it approved. Okay. So we serve as that middleman. So it's very important for us to know the ins and out of a customer, the ins and out of their business, because the underwriters are just going to get the numbers. They're just going to get the financials and do some spreading. And so we match, we're storytellers. We get the story from the customers and we paint a full picture for the underwriters who only are seeing the numbers.
Yeah. The next question, Mike, he says, oh, go ahead. I'm sorry. I'm just taking your space.
Go ahead. What do you recommend to start maintain that relationship, even looking for a loan per se, if you could put your contact information in the chat, or if you want, how you want to disperse your contact information for people in case they want to get a hold of you.
Yeah, you want to?
Yeah, I can type our stuff.
But the last part, you want to type it in or you want to send it to Merlene? Merlene, is it best to send it to you? That way you can just send it out or get it to the right person that's on here, or is it best for us to put it on this chat?
I think people has been putting, but I don't know if you can now. So I have your contact information. So Deborah has it too, but if you want to put it in the chat, you can, it's fine.
All right. Okay. That's fine. But
the next session is starting, so we're being told to shut up, I think.
Look, I understand. I there was a question, so we can answer that real quick. To start a conversation, you don't always have to look for a loan. There's certain clients that just have a depository relationship. It's not about you needing it right now. It's about when you need it. So it's just like, I guess I use the analogy being from the South. My grandmother always said, if you're courting somebody, you got to put time and effort in so they can like you. So that's how I look at it from a business standpoint.
Right.
Thank you.
Thank you both for your time. We really appreciate it. Great action.
Thank you.
Thanks everybody that attended. Thank you.
Yep. See you.